Welcome back to The Explainer. We're getting right to it today. We are popping the hood on the Vanguard S&P 500 ETF, the massive powerhouse we all know as the VOO. But we aren't just skimming a list of tickers. We're doing a complete top-down valuation reveal of the top 42 stocks driving this index. We're going to find out exactly which of these names are severely overvalued right now and where the actual hidden bargains are sitting. Here is our roadmap for this analysis. First, we'll establish our valuation methodology. Then, we'll categorize every single one of these 42 holdings, identifying the overvalued ones, digging up the undervalued bargains, applying a strict Buffett-style quality check, and finally, delivering a bottom-line verdict on the portfolio as a whole. Let's get into it. Part 1, Valuing the VOO portfolio. It's time to break down these top 42 holdings. Moving on to Part 2, the valuation methodology. Think of this as the ultimate lie detector test for stock prices. To strip away all that market hype and see what these 42 companies are actually worth, we're relying on a rigorous 3-step framework. Step 1 is a strict discounted cash flow, or DCF analysis. We are estimating a hard fair value range using future earnings and free cash flow models. Step 2 layers in traditional multiples. We're talking PE, return on equity, and PEG ratios to see how the price stacks up against its growth. And finally, Step 3. We apply Warren Buffett's qualitative rules, sizing up competitive advantages to judge every single business completely impartially. Now, the absolute crux of our entire analysis today is the margin of safety. This is simply the difference between a stock's true intrinsic value, what our models say it's genuinely worth, and its current market price. If the market price is sky high compared to that intrinsic value, you've got zero margin of safety. But if it's trading below, that's where you find your cushion. Part 3, the overvalued holdings, where the market is pricing in extreme optimism. The sheer premium placed on hypergrowth names and top-tier retailers right now is pretty wild. Right off the bat, you've got Apple hovering around $293 with a PE of 34.3. Our DCF models suggest it's anywhere from 8.5 to 46% overvalued. And crucially, Warren Buffett himself has been a net seller. Then you have Broadcom sitting at a massive 81.3 PE. And Costco, it's an incredible company, no doubt, but at roughly $998 a share and a 52.3 PE, the market is leaving literally zero room for error. We're also seeing highly cyclical names like Micron, Caterpillar, and Applied Materials all trading at significant premiums compared to their fair value ranges. But some of these numbers are just jaw-dropping. Take Tesla. Our DCF models consistently show it is massively overvalued by 164.4%. It's trading at a staggering 320 times trailing earnings. The models put its fair value somewhere between $38 and $215. So with a recent price near $398, investors are essentially paying upfront for years of absolutely flawless execution. And this hypergrowth premium bleeds right into software too. Palantir's PE ratio is over 100x. When a company trades at over 100 times its earnings, the market is pricing in wildly optimistic, virtually perfect future growth just to justify what it costs today. It completely lacks any traditional margin of safety. Which brings us to Part 4, the undervalued bargains. Let's find that margin of safety. Now we're talking. Scanning through these undervalued names, there's a huge concentration of financials, healthcare, and energy giants. Look at JP Chase, rocking a PE of just 15.5 with massive free cash flow. Check out the energy sector. Both ExxonMobil and Chevron are showing a 35 to 50% undervaluation based on our models. Then you've got Johnson & Johnson, carrying an incredibly rare AAA-rated balance sheet completely on discount. Heck, even Berkshire Hathaway itself shows an intrinsic value comfortably higher than its current market price. These are your steady, defensive stalwarts, offering a legitimate margin of safety. The contrast right within big tech itself is absolutely fascinating. Just because a stock is a massive tech behemoth doesn't mean it's inherently overvalued. Apple carries a massive premium, and legendary investors are trimming their stakes. But flip over to Meta. It's currently sitting at a nearly 30% discount to its intrinsic value. It boasts a highly efficient 22.1 PE and a 32.8% return on equity. They're in the exact same index, but with entirely different valuation realities. Rounding out the full 42 stock picture, we have the remaining 15 stocks that fall firmly into the fairly valued or mixed middle ground. You've got heavyweights here like Nvidia, Microsoft, Amazon, and Alphabet. Nvidia is sitting at a mixed to slightly overvalued state. Yes, its 55.6% net margin is unbelievable, but at a 44x PE, it just doesn't offer that strict mathematical margin of safety. Further down the list, you'll see massive compounders like Visa, MasterCard, and Walmart. These are high-quality businesses with wide moats, but right now the market has them priced fairly. No steep discounts, but no outrageous premiums either. Part 5, the Buffett quality check. We have to look beyond the math. Now that we've crunched the numbers, we have to evaluate the real-world business quality. Because at the end of the day, a business is only as valuable as the predictability of its future cash flows. A cheap stock is absolutely not a bargain if the underlying business is failing. And honestly, a pristine mathematical model is totally useless if a company's earnings swing wildly from year to year based on shifting fads or massive economic cycles. This brings us right to the concept of the moat. Many of the VOO's top holdings boast durable competitive advantages that fiercely shield them from competition, which is exactly what Buffett screens for. We're talking about Apple's incredibly sticky device ecosystem, Microsoft's absolute dominance in enterprise software, JP Morgan's sheer banking scale, and the massive Visa and MasterCard payments duopoly. These moats are exactly what protect the earnings power our DCF models rely on. And this perfectly illustrates the divide when we look at earnings consistency. On one side, defensive stalwarts like J&J, Procter & Gamble, and Coca-Cola offer the kind of rock-solid consistency Buffett loves. You can practically set your watch by their cash flows. But on the flip side, highly cyclical or intense growth stocks like Tesla and Micron carry way more earnings volatility. Their moats are constantly being tested by intense competition or extreme industry boom and bust cycles. That makes pinning down their true intrinsic value a whole lot harder. Finally, Part 6, the final portfolio verdict. Let's look at the big picture. So, we've run the models and we've applied the moat analysis. The data reveals a massive valuation dispersion splitting right down the middle of the ETF. Out of the 42 biggest drivers of the market, 22 of them lean overvalued, ranging from slightly pricey to just massively overextended. Meanwhile, 20 present potential undervalued opportunities, currently trading below their intrinsic worth. It's literally a tale of two markets coexisting inside a single index fund. The big takeaway here is that while the broader index is being driven higher by heavily priced tech giants and hypergrowth narratives, right beneath the surface lies a rich vein of high-quality, undervalued compounders. Financials, healthcare giants, and energy majors are stepping up and offering the exact margin of safety that the market's tech darlings have seemingly abandoned. As an investor, this leaves you with a really fascinating choice. Do you just settle for the aggregate valuation of the index, eating the heavy premiums of the overvalued stocks just so you can own the whole basket? Or do you hunt for the deeply discounted bargains hiding inside it and build your own portfolio of undervalued compounders? The numbers don't lie, but the strategy is entirely up to you. Keep analyzing, stay sharp, and I'll catch you in the next explainer.